Well, is the window closed for Obama to enact any kind of meaningful reform at this point?
He certainly hasn't enacted meaningful reform, and there certainly hasn't been anything from Congress that has been passed that has been meaningful. I like to hope that the window isn't passed, but unfortunately, when you look at signs like the top 4 CEOs getting in front of the Financial Crisis Inquiry Commission and basically defending their practices, saying, yeah, we made some mistakes, yeah, we didn't know home prices could go down, we were just doing what our clients wanted, we were marking our positions, or depending on the firm, different things were said. And that kind of thing, without a lot of in-depth inquisition, which there wasn't, doesn't even give additional hope to changing the kinds of regulations that we need to really stabilize the system going forward and contain it from the way in which it's doing. So I don't think Obama's done any kind of a job in doing that. Every so often he talks about containing bonuses or containing risk, and they shouldn't go back to risky practices. But the reality is they have.
Yeah, Obama's reaction to the whole crisis seems to be like the typical brokerage customer who gets their monthly statement one month and finds out that they're down 30 or 40%, and they just kind of smack their forehead and say, gee, what happened? You know, he doesn't seem to have a clue as to how these guys work and what the basic operating procedure is on Wall Street, which, as you detail in your work quite exemplary, is a method of more or less accounting fraud and other ways to rape and pillage. And the title of your book, of course, is It Takes a Pillage. Now, in a recent interview with CNBC, Treasury Secretary Tim Geithner was at a complete loss to explain the culture of Wall Street. He claimed to have no idea whatsoever how bankers could award themselves such huge bonuses. Can you explain it for us, Nomi Prinz?
Well, you know, I think, first of all, Geithner and such don't really understand the risk that is required to create those kinds of bonuses. We know when the risk went wrong in 2008, bonuses were slightly reduced. We know now in 2009, as banks have been stating their earnings results, that those bonuses are way back above 2007 or pre-crisis levels. But the bonuses aren't even so much about the numbers. They're about the risk that these banks are taking in order to create the trading profits that then underlie those bonuses. And that's the thing that never gets really discussed properly in Washington. You get these like slap type Obama statements about, you know, reckless behavior, but while he's talking, this reckless behavior is continuing, and that is what underlies the bonuses. And there has been no meaningful restraint, not just of the bonuses, because that's just a symptom of the problem of the risk. There's been no meaningful restraint of the risk itself, and that's part of the problem. Today, this year, the revenues that all these major firms that have floated on government capital, that in many cases still do, even when they've repaid TARP, still have access to the Fed window, still have access to cheap loans, still use that access in the past to generate more capital. All of that, most of that goes into trading. It doesn't go into consumer business. It goes into their trading revenues, which we can see at companies like Bank of America, like Citigroup, like JP Morgan Chase. They're being carried by trading. They're not being carried by their customer businesses. Mortgages, consumer loans, commercial loans, all of those things continue to erode. That's not the part of the business they're banking on, so to speak, these banks. They're banking on cheap capital behind trading risk to generate profit, and from that to generate really huge bonuses. And that model has not only not changed, it has gotten worse, because now their capital isn't really just coming from the private sector and from their investors. It's coming from public money. It's coming from the opening of the federal government to really subsidize this whole process.
Right. I mean, the connection between bonuses and risk. It's not really what most people assume, that the bank's taking risk and they're being compensated to take risk. No, that's not what's going on at all. The bank are recklessly taking risks, and when the risks go bad, they simply have their losses paid for by the government. So, again, it's not a real business model or a banking situation. This is a hostage situation where the banks have taken Geithner and the Geithner is part of them, of course, so they've taken the American people hostage. And the result has been, yeah, go ahead.
No, that's exactly the case. And while they're doing that, they say they're not. They're having all these conversations about how we can't let too big to fail really be our policy, while it is their policy. They're saying what we need, and this is some of the regulation that's being discussed. It hasn't been passed, but that's the level at which it's being discussed. We should have a better resolution authority or a procedure that if these big banks start to fail again, we can wind them down or bankrupt them or whatever in an orderly fashion. In other words, once the patient is dead, we can find the gravesite. But not what do we do in the operating room to make sure that the patient doesn't die so that we don't have to deal with the death or the cost of that death or anything else, which is currently the situation, because there isn't really any discussion about, for example, breaking up the banks, bringing back Glass-Steagall, which was the 1933 act that said, if you're a financial institution and you want to take risk, you want to create securities that are risky, you want to use capital to bet, that's really great. You go do that, but you don't get any federal backing. However, if you're dealing with consumers and you're dealing with the public and you're taking deposits and you're making loans and you're using your capital for that purpose, then, you know, we will back you if there's an economic problem. We will work together as the government. We will have the FDIC, which was created back then to ensure deposits for depositors. But you don't get to do both. And what we have now, and that was largely because of the repeal of that act in 1999, we have a system that has that risk and those deposits tied together in one institution, which is why the federal government will go in and back this risk to save this side. And this risk, again, is what causes the immense problems in the system as well as perpetuates the bonuses. You don't get the big bonuses from dealing with the boring old consumers.
Right. So
as if you're a bank.
The pushback, of course, from mainstream television in America is that this smacks of wealth redistribution. I think the argument would make more sense if those arguing to break up these big banks would talk about not wealth redistribution by attacking the bonuses, but talking about risk redistribution. That is to say, make these banks take the commensurate amount of risk that goes with taking these enormous bets. If those two things were in sync, then we'd see the banking system and the economy would come closer to balance. But I want to move over to AIG for a second. Geithner also said that the New York Fed paying out 100 cents on the dollar to AIG's counterparties, the principal one being Goldman Sachs, was absolutely the right thing to do. Your thoughts?
Well, everything he thinks he did was right in his mind. This is why he's very dangerous to have as the Treasury Secretary and why he was dangerous to have as the President of the Fed for the rest of the population, not necessarily for the banking system, who was quite happy about the arrangement. His idea was that, well, we had to pay 100 cents on the dollar out because we didn't have time. You know, it was too chaotic. It was too much of a crisis in the system. If we didn't take care of it right away, if we spent time haggling over things like they're not really worth 100 cents over the dollar, the entire system would have imploded even more quickly and even more destructively, which is just not true. There are everyday negotiations.
They all think they're Jack Bauer, an episode of 24. Now, I want to get to a quick question here. Was the transfer of wealth from taxpayer to Goldman Sachs via the conduit of AIG a crime?
It is a moral and ethical crime. It shouldn't have been done. It shouldn't have been a decision that was undertaken. In terms of the legalities of it, it's harder to say because AIG is technically classified as a savings and loan. It's technically classified as a bank, even though it's actually a hedge fund that does some insurance. So it sort of was under the umbrella. And Geithner and Bernanke, who was head of the Fed, of course, and will be probably confirmed again this month, is you know, they could, under their mandates, under what they consider emergency powers, do what they consider necessary to do to keep the banking system afloat. Now, should Goldman Sachs, as almost up until the moment before they got the money from AIG and other subsidies from the federal government, they became a bank holding company. They went to the Fed with Morgan Stanley on a Sunday night. They were starving for capital. They were facing bankruptcy. This is something that doesn't get discussed too much. You don't go to the Fed Sunday night when the rest of your industry is imploding if you have enough capital or survive. You change your name, you get the approval, which the Fed gave, did not wait for its general 5-day antitrust period, just said, yeah, okay, go for it, you're bank holding companies. Therefore, you get Fed backing. Therefore, if the federal government is going to save the system, you're now part of that system, the bank holding company system, that can be saved. And AIG is one of your counterparties. They have you and they have contracts amongst each other that have risk behind them that the government will pay for, because that way you'll stay afloat. We're trying to keep AIG afloat because of the relationship with Goldman and every other bank that they were talking about at the time. Of course, Goldman was the major recipient of some of that money, the $12.9 billion worth of it. But from a legal standpoint, those are very murky decisions, and I believe they are the wrong decisions, and they should not have been done. And Goldman had no right to instantaneously become a bank holding company and benefit from 100 cents on the dollar using AIG as the middleman. Those conversations should not have happened.
Well, it's murky by design, and in my view, that's a crime. All right, Naomi Prince, thank you so much for being on the Keiser Report.
Thank you so much.